So many of us, we try to do the right thing. We try to build that perfect investment portfolio. We do our homework, we pick a bunch of different funds, and we think we're being really smart and sophisticated. But what if all that hard work is actually a trap? Let's dig in.
So, does this sound familiar to you? You're spending your nights staring at a dozen different tickers, trying to make sense of it all. But it feels like your money is just stuck. It's like you're spinning your wheels, just drowning in data.
Well, believe it or not, there's actually a name for this feeling. It's called complexity fatigue. It's that total exhaustion that hits when you're managing this supposedly sophisticated portfolio, but it's just not giving you the results you hoped for. It's that nagging feeling that you're in control, but your growth is just flatlining.
So, what's really going on here? Well, at the heart of this whole problem is a myth that a lot of investors fall for. The idea that owning more funds automatically means you're more diversified and therefore safer. But we really need to question that.
And this right here, this is the core of the issue. On one hand, you have the belief, hey, I'll add more funds to spread out my risk. But then there's the reality, which is often hidden. Adding more funds often just means you're buying the same exact stocks over and over again. You feel like you're playing it safe, but in reality, you might be doing the exact opposite.
Okay, so how does this even happen? We've got to pull back the curtain on a hidden flaw that sneaks into so many well-meaning portfolios. It's something we call the overlap trap. All right, let's make this super clear with a common example. Let's say an investor buys VOO. That's an exchange-traded fund, or ETF, that tracks the S&P 500. So now they own a tiny piece of 500 of the biggest U.S. companies. Then, to diversify, they buy another fund, VOE, which focuses on mid-sized companies. Seems like a smart move, right? Large companies, mid-sized companies, totally different things. Yeah, but here's the kicker. When you actually pop the hood and see what's inside these funds, it's kind of shocking. A whopping 92.1% of the companies in that diversifying mid-cap fund are already in the S&P 500 fund you own. This is not diversification. It's just duplication.
I mean, just let that number sink in for a second. 92.1%. So what does that actually mean for your wallet? It means you're literally paying 2 sets of fees to own the exact same stocks. You've added all this complexity and extra cost for basically no real diversification benefit.
And this is where it really starts to hurt. Because all this unnecessary overlap, it has a real tangible cost. It means you're paying fees on top of fees, and it's silently draining your wealth year after year.
This quote, it just nails it. Fees can seem so tiny, almost invisible, right? But just like termites, they just quietly chew away at your financial foundation, and before you know it, they've done some serious structural damage. So what are these termites? Well, the main one is called the expense ratio. It's just a small annual fee that every fund charges you. The problem is, when you have these overlapping funds, you're often paying a higher fee for a specialty fund to own stocks that you already own in a much cheaper fund. And look, I know a small percentage doesn't sound like a big deal, but over time, the damage is just wow. A seemingly tiny 1% difference in fees over a 30-year investing journey can mean $250,000 gone from your final retirement savings. That's money that should have been yours.
Okay, so that's the problem. It's a bit scary. But how do we get out of this trap? Well, the good news is the answer isn't more complexity. It's not more charts or more research. It's actually simplicity. We'll call it the simple endurance strategy.
It really just boils down to 3 simple but super powerful steps. First, you're going to pare down. Second, you automate. And third, and this might be the hardest one, you just have to be patient.
So what does this actually look like? Well, first, pare down. This just means cutting back your portfolio to 1, maybe 2, or at the most 3 simple low-cost funds that cover the entire market. Next, automate. Set up those regular automatic deposits so your money gets invested consistently without you ever having to think about it. And finally, be patient. This is where you adopt the lose-your-password mindset. You set it, forget it, and you stop yourself from making emotional decisions when the market gets a little shaky.
And that right there, that's the big mindset shift we're talking about. The goal isn't to be some stock-picking genius constantly buying and selling. The truth is, for most of us, the real path to wealth is simple and passive. You buy the whole market with a cheap fund, and then you just get out of your own way. So if there's one thing you walk away with today, let it be this. Stop counting how many funds you have. That is not real diversification. True, powerful diversification comes from how much of the market you own. So ask yourself, am I owning thousands of companies from all over the world with just 1 or 2 simple funds? Because if you are, you're probably way more diversified and paying a lot less in fees than the person juggling a dozen overlapping ones. Why make it any more complicated than